Hi everyone, welcome to Coffee Chat with Chen. I'm Chen Ganesharaja, the Managing Principal at WealthBridge. Every month, we sit down with entrepreneurs, thought leaders, and industry experts talking about all things wealth, including how to build, preserve, and transfer your wealth in a tax-efficient manner. If you're an investor, an entrepreneur, or an individual looking to secure your financial future, this podcast is absolutely for you. So grab your coffee, sit back, relax, and enjoy as we discuss how to build lasting legacies. Welcome to the conversation. We have a very special guest with us today, Mark Aloysius. He's a portfolio manager with Newport Private Wealth. He's a certified financial planner as well as a holder of the CFA designation, Chartered Financial Analyst. Mark, welcome to the show.
Great, thanks Chen for having me. Appreciate this.
Absolutely. Mark, tell us a little bit about you and a little bit about how you got into the industry as well.
Wow, okay. Well, a little bit about myself. As you said, I'm a portfolio manager at Newport Private Wealth. If I can go way back for a second, if you would indulge
Please.
me, just going back to young Mark as a 8-year-old or 9-year-old, I didn't know that a career on Bay Street was calling me as a 7-year-old or 8-year-old, right? I think at that time, I had this idea of maybe being an astronaut or something, or being a police officer. I had a different idea every time. So it was only until maybe later in my high school and university years that these careers even became evident and apparent to me.
Yeah.
If I think about how I got into where I am today, it was a lot of incremental building up. I sort of started at the ground level, if you can call it that. I was working at the investment call center as my first kind of job in finance, if you want to call it that. Sure. Taking calls from clients that wanted to use our online platform but didn't know what these terms meant, and
Sure.
educating them. And that was when I was 21 or 22, a young man, and then kind of incrementally building up, as you said, getting my licensing designations,
Sure.
The financial planning and the Chartered Financial Analyst designations, and building up. I realized at the time, working at the call center, that was execution only. So you just pick up the phone and you put in the order for someone. Someone wants to say buy shares of Microsoft.
Sure.
At the time, you would sometimes call in to make trades because we were still kind of moving into a full
yourself.
online
Yeah,
platform.
absolutely.
I know.
Yeah,
It wasn't
which is
actually
good.
that long ago, but it was
Well, shows your depth of
pre-COVID.
experience within the space, absolutely.
For sure. It's been a little, and there's been a lot of technological improvements, obviously, in the industry. But really cool experience there to learn the ins and outs of the industry kind of at the trading floor, if you want to call it that,
Sure.
like at the ground level. But you couldn't give advice. That was the restriction. It was execution only. People are putting in their trades and you're assisting. Sure. And then I would see people make really big mistakes sometimes. Even as a 21 or 22-year-old, I would know that was a mistake.
Sure.
And these are things that I think I picked up even from my university days, not just economics background, but things like investor psychology and behavior, and following the herd, for example, or market panics. And then you would see someone selling at the bottom or selling when there's some bad news, or you would see someone buying something which didn't really have a credible history, but it was a kind of a hot story.
Sure.
Putting all your money into one thing, which we'll talk about, I'm sure, diversification.
Yeah,
so it just led me to this idea where I want to give advice. I can't do it in this channel, so let me break into the part where I can give advice. And then step by step, working at the advice parts of the banks, and then now more on the independent side as a portfolio manager, where basically it's investments first. We try and construct very solid portfolios for clients as the core, but then we try and pair that with really holistic financial planning, kind of stepping into some of what you do and what you care about a lot with succession and estate planning and legacy and everything, trying to look at the whole picture for clients, and then partnering with people like yourselves to kind of deliver the whole thing. So it's really, I tell people, it's creating certainty when there's financial uncertainty, helping people define their goals, and making those goals reality. And that could be anything about finance, from your investment portfolio to should I go fixed or variable on my mortgage? I can give you my opinion on that.
Sure.
Anything about money, I want to be the kind of starting point for clients that have those kinds of questions in their mind.
Amazing, amazing. So just because I think when we hear the word portfolio manager, sometimes some people may not make that up for financial planning. They might think, hey, you're constructing a portfolio per se from an investment perspective, but it's fair to assume that you do both financial planning for clients as well as being able to come up or constructing portfolios that aligns their goals with investment options that are out there that's available.
Yeah, exactly. Like the title of portfolio manager is a regulatory title.
Okay.
So I'm a licensed portfolio manager. I have the license across the provinces that I practice in.
Sure.
But the actual wording in the regulation is I'm considered a registered advisor.
Okay.
Right. So you're registered to give advice, really.
Sure.
Advice on securities.
Sure.
But that advice should kind of span anything regarding financial matters.
Sure.
So there's sort of different ways of looking at portfolio managers. If you work at an asset management company like a mutual fund, then your job might just be investments only. You're doing pure analysis, you're behind the spreadsheets, and you're kind of optimizing for how much should we have in stocks and bonds, and there's not a lot of the private client stuff.
Sure.
Me, I'm to kind of give this distinction, I'm a private client portfolio manager.
Sure.
So there's the investment side of it. We have an investment committee that works together on creating the investment strategy that works for our clients.
Yeah.
But then now it's also working with people directly and guiding them through tough markets, some volatility, guiding them through some tax planning, multi-generational planning. So it's many hats.
Yeah.
You know, it's a bit of a financial coach at times.
Yeah.
It's a bit of a financial therapist, I feel, at times, right? You kind of have to wear different hats. But it's, the PM title is sometimes a little bit ambiguous, so hopefully that clarifies a little bit
absolutely.
about what
Absolutely.
the role is.
Yeah, and we'll dive right into it. I mean, I think something you brought up was, hey, it's just like being a financial coach for, people at times, right? Just because, we hear a lot of what's happening in the market outside, and of course, sometimes we see a lot of paper losses based on, a lot of things that's going on, but emotional biases get into people's head, and sometimes they pull out the money, when they shouldn't be, et cetera, right? Yeah. What's your thought on it? How do you what are you seeing out there just in general, and how do you sort of mitigate that part of the process?
Yeah, so I'll even go back a little bit into my history for a second, if you'll let me, just because I think it's helped me in how I approach the study of the market. When I was in university, it was a liberal arts degree, so it wasn't a pure kind of business school degree, and they would let you do, apart from economics and finance, you could do other stuff. So I, for example, filled my curriculum with some psychology courses, some history courses, and that may have looked at the time that I was kind of wandering and I didn't know what I was doing, but I really wanted to have a broad education. Sure. And that's, I think, prepared me really well for understanding the market a bit better, because I tell people, like, to really know the market, it is economics for sure, and it's finance, and it's reading the Wall Street Journal and that kind of stuff, but it's also, to your point, investor psychology, it's emotions, history repeats itself a little bit, right? Sure. Not the exact same way, but there's now 200 plus years of market history. So you can look back at what happened in the 1930s, even like the 1800s. There's things that happen again and again, market panics, bank runs, panics, manias, that kind of thing. So that's all history, but it is also helpful to talk to clients about 100%. Things that we're seeing today. So kind of going back to your question, when I'm guiding clients through what's happening today, one starting point is history, right? You look back at, of course, nothing has happened just like this in the past, right? Sure. Things are a little bit different, but there was periods in the past of high inflation and markets coming down, right? There was times when the Federal Reserve's independence was being pressured. Like, that's happening now, and that happened as well back in the 70s, for example. There was many different flavors of bear markets, and just what lessons did we learn and all that. And the one that I come back to is, if you look at the chart, the kind of the 100-year chart, it is still upwards and to the right, right? It's still going in the right direction. So it's harder, easier said than done, but having the long-term zooming out does help, where you kind of get a sense of, like, okay, this feels kind of scary, but it was also scary in COVID. If you not in too far in the past, but if you look back in March 2020, pretty scary time, right? The new thing was happening. We didn't know if the economy would be shut down for 2 years, 3 years. How long would this happen? And then there was a sharp correction for a short time, 08, 09. So history has its lessons. And then the other is the psychology part, right? Just
Yeah.
trying to talk people through, their biases potentially. You kind of frame things a different way.
Sure.
So one thing is clients' liquidity needs. Do you need this money today? Usually not, right? Usually you just, the paper loss, to your point, right? You see that it's gone down 30% or
Sure.
even sometimes 5 or 10% still feels pretty rough, right? But you don't need to cash it out today. And then using the history side of it, of knowing that it can bounce back, hopefully that's enough. But it is a lot of, you've got to be empathetic and talk to people about, these are real feelings that you're feeling, right?
Sure.
But hopefully giving them some logical kind of talking points to reframe that thought process. And
And I think this is where the planning piece of it really comes in handy at the end of the day, right?
Absolutely.
Like, hey, if we started something and invested in something with the intention of maybe using it in 20 years from today, and of course you've crafted a portfolio that'll help you get to that goal, why are we talking about 2 years in because of what's happening outside in the noise, like the markets, right? So helping people understand that, hey, if we need to get to that 20-year mark, maybe staying the course to get there, just trust the process and sort of let us help you get there, and that usually helps people maybe understand that part of the process as
for
well.
sure,
right?
yeah, for sure. And then going to the point on planning too, because I haven't. I think in general for financial planning, you don't assume a very aggressive rate of return, right? You want to be conservative and model a variety of scenarios. So we would, for example, use a conservative rate of return, right? Let's call it, I don't know, 4 or 5% or something, right?
Sure.
So that rate of return will allow for some down years, right?
Sure.
Like a 5% rate of return will allow for some years you might be down 5 or 10, and then some years you're up 20, and then you get to the 5% longer term. So I think when you kind of start with this number of the plan shows that 5% works, right? The plan might even show that 3% works. It really depends on someone's circumstances. So in that case, for us to be down 10% now, knowing that markets will bounce back eventually, and the plan works, then we should really just step back of why is this happening? It is just an emotional reaction, which is understandable. But when you bring it back to the plan, then I think you can kind of gives people some peace of mind that, okay, like, I'm going to be okay regardless. I don't need to cash out today. The plan's built for these types of downdrafts, and I just got to turn off the news, which is easier said than done, but maybe just trying to turn off the noise or turn down the noise slightly, right?
Of course. And just if you were to sort of, what is your outlook when it comes to sort of financial planning? Just in the sense that, hey, long-term investing is something that we talk about quite a bit, but of course, if what happened in the real estate space in that 2021, 2022, I would talk to some investors sometimes and they're like, hey, you know what, we can double the money in real estate in a few years, because you hear people are misinformed as to what can happen. I still fundamentally believe even real estate, it's a long-term game at the end of the day, right? But when we now talk about capital markets, like what are certain basic principles that people should just really fundamentally know when they're investing in stocks, bonds, or other type of capital market instruments?
Well, one, I mean, for someone who is maybe a younger investor who's not invested yet, I think taking the leap is a little bit scary, especially if you're doing it on your own without an advisor, and you want to look at the plethora of ETFs and investment options out there, and to get started is kind of scary. But getting started, getting invested is the first thing, right? If you have cash and you're just accumulating cash, and you have a gainful, steady paying job, and you have a bonus maybe, and that's working well for you, that's fine. And especially when you're young, you want to get the power of compounding now working for you, right? Like supercharge that, and then especially if you have a 30-year time horizon, you can afford to have some volatility and a couple negative years here and there. So the first step is getting the mindset that you just have to invest early, invest often, get started. And then it is, to your point, the diversification really, right? Like you want to have the principle of don't use history or recent history as the starting point, right? Like real estate investing has been around for millennia, right? And we shouldn't just think that just because it worked last year or worked 2 years ago, that's going to keep happening. There's no free lunch on Bay Street or Wall Street, as they say, right? And sometimes people have got the impression that certain asset classes, perhaps real estate, feels like a free lunch. Oh, I'm just, I live in my investment, right? Like this, my family house where my family resides is also going up 10% a year.
Sure.
So that was great, and that may resume
Sure.
at some point in the future. I'm not going to knock that, but I think it's better to plan for the possibility that doesn't work, right?
Of course.
Like, you maybe just dial down the assumption that the real estate might grow at, say, 2% a year or
Sure.
something, 3%, a reasonable rate of
very
return,
reasonable rate,
right?
yeah.
It's not going to necessarily double every 7 years or whatever it is. And then now what else should your investment assets look like, right?
Sure.
And then that's where maybe the education comes in
Yeah.
on things like, if you have a little bit of an aversion to investing, just what are equities, what's fixed income, what's the purpose of these in a portfolio. We can get into alternative investments, which is maybe another kind of learning curve as well.
Yeah.
But just everyone's familiar, obviously, with real estate. It's like a very easy to understand investment,
Yeah.
right? We live in it, and it's a physical piece of property.
Sure.
A piece of paper that says that I own a share of some company
Sure.
going up and down by a second
Yeah.
is a little bit harder to grasp. So I think it needs maybe some education to
Yeah.
bridge that. Yeah.
And maybe we'll just jump right into it, right?
Sure.
Let's maybe zoom out a little bit and just, if we're talking, people are familiar with the concept of stocks, just in general per se, but we obviously characterize that or classify that as an asset class that's equities, or you talk about that, but why don't you maybe break it down in terms of when we think capital markets or markets in general, we talk about equities, or we talked about fixed income or bond portfolio. Talk to us a little bit about what are some of the different segments and what are some of the pros and cons, just at a very high level.
For sure. You're right. I mean, I think stocks is the one that most people have some knowledge of. It's got the most brand recognition, we'll say. It's it's in the news more often.
Yeah.
Maybe I'll just start by defining what they are. There's two categories really, right? There's the public markets, the capital markets, to what you were saying, is one category. And then there's the private markets, which is its whole other world. That might be another podcast, really.
Yeah,
right?
no,
I could say
absolutely.
that for another day. But starting off with people's, what's more accessible, the public markets, it is stocks and bonds. Yeah. So what is a stock? To bring it down into really
Simple,
elemental,
basic.
simple terms, right? It's you're buying a piece of ownership in a company, right? So you're taking ownership in a company. So that's not speculating. You're not doing this because you think it's going to go up tomorrow or next year. Sure. You're doing it because you are now an owner, right? Sure. You're now a business owner. As a business owner, you have certain rights. You maybe have entitlements to dividend payments and the share appreciation over time. Yeah. Right. But that's how it should be thought of as a starting point. It's you're buying a piece of a business. And that maybe makes it more realistic than, it's a piece of paper, it's something I see on my investment account trading screen, it's a gamble, I don't maybe want to throw a bunch of company names specifically, but if it's XYZ company, right, I am now a part owner in that company. Think about it that way, as a business owner. The fixed income market is actually bigger by magnitude than the equity market, but it's a little bit more boring, so it doesn't get a lot of the play in the media. But essentially, these are the debt markets or the borrowing markets. So, if I'm a company, if I'm XYZ company, I have two ways to raise money. One is equity. I can give some ownership in my company away, and that might be through public shareholders like you and I. One is I can borrow. So I can go to the bond market and say, I want to raise $10 million. Who wants to lend me this money, right? And then it might be people like you or I, or pension funds, that kind of thing. So the fixed income market is these lending markets. The kind of traditional thinking is equity market, great long-term growth, but more volatile, right? Fixed income, maybe steadier, but lower returns, much less volatile. It's not always the case in practice, especially on the fixed income side. Fixed income can be volatile too sometimes. Recently, we've seen that in the fixed income markets, like just a lot of volatility and things that would normally not be as volatile. So that's where diversification comes in. But in a nutshell, it's that. It's kind of slow and steady, and then you got your more high octane, and then the balance between them is kind of defines the portfolio for a lot of people.
Perfect. Just because I think you did an absolutely fantastic job in terms of just describing both, but if you talk to an average investor, and let's talk about young people who are just, hey, like I have some extra money, I'm throwing it out in the markets, I just want it to grow, I'm experimenting, which all of it, which is perfectly fine, right? But I feel like when you talk to them, they're sort of picking stocks based on, hey, what's happening outside, what person XYZ is doing, not always necessarily value-based investing. Like, I know I've always had the perception that, hey, if, again, my perspective is that if this is a company that I would buy goods from, then I would maybe invest in that company, just because that's how I took a sort of a perspective on that. But do a lot of young people invest within the fixed income market or the bond portfolio? And I would understand why, and I think I know the answer, but why do they not get involved with it?
Yeah, I think, well, part of it is, I think there's a learning curve. I think people kind of have this idea that fixed income is boring, it's super slow, is low returns. I'm young, I have a long time horizon, I don't need to mitigate my risk. And then a lot of that, is frankly kind of true. Like, it's maybe not appropriate for someone who's starting out 19, 20, or even 30 to have a large allocation to fixed income, because you have a long time horizon, right? If you're 30 and you're hitting your earning years and you're going to be saving and investing a lot, then it makes more sense, depending on your personal risk tolerance and everything like that, to allocate more to the part that's going to grow more longer term. The fixed income, where it comes in for a lot of people, is kind of the counterweight to the equity, right? It's the balancing part. And traditionally, not to get too financially wonky, right? But the term would be the fixed income markets have a negative correlation with equities, right? So when equities are going down, traditionally fixed income has done well. It's kind of a safe haven. People go into the safe stuff, and then it does well, it goes up. So if you want to have some balance over time, it's made sense to have some in the fixed income part, so that when your stocks are not doing well, your bonds should be doing well. And to a young person, I would say, if they're kind of hesitant on fixed income as a part of their portfolio overall, I would just say, well, look at your overall portfolio as it is today. Let's say it's $100,000, okay? If it was to drop 50% tomorrow, which can happen if it's stocks, we've seen that in 2008, right? So would you be okay with having no access to your portfolio until that recovery happened, right? Exactly. And sometimes those liquidity needs are not anticipated, right? Like you have something happens in your home, the boiler breaks, you need a new car, a big tax bill. So you don't want to necessarily, just because life happens, have all your money tied in stocks where, oh, I have a big tax bill to pay, my stocks are all down, and I have to sell something now at a loss to pay my tax bill. Why not just have 10%, 15% in the bond portfolio? That's going to have a lot less volatility, and then it's like, okay, I can cash in from that part of it to pay these things, which I don't anticipate but could happen sometimes. So it's risk management more than it is anything else for a young person.
Just as important as it is to build, wealth, it is just as important to preserve what you're building, and really a fixed income portfolio can maybe complement that, an equity portfolio to be able to help make that a piece of that happen.
For sure. Yeah, you can take, for someone that, if I think about young people and investing, like a lot of people got into the market in my kind of age cohort in their 30s, like around COVID, right? Like that was a time when there was a bunch of Reddit forums, and there was a lot of do-it-yourself investing. And I'm really kind of happy that that happened, because I think it kind of made investing more democratized. And a lot of people know more about investing now. But the downfall in some ways was it was an uninterrupted 5-year period of the markets doing well. So a lot of those early investors have not been tested yet until recently, right? This has been their first period of, oh, wow, it can go down a lot in a short time. I saw this happen in COVID, but COVID kind of bounced back quickly. Now it feels a little different, and I'm seeing different parts of my portfolio going down a lot. So it's it is good, again, for people that have that shorter history to look back at history now, right? You've been investing for 5 years. The market's been around for 200 years. Let's look back at what's happened before. And then, keeping calm, having diversification, which we'll get to. But that's
absolutely. And on that note, Mark, is it fair to assume, so as you get older, there are various factors that obviously goes into building a portfolio that might make sense for you. And if you were to touch base on a few, but I would suppose time horizon, your appetite for risk, just when you wake up one day, what you see tomorrow will make a big difference in somebody's life. But what are some factors that typically goes in at a very high level when you decide which should be sort of an appropriate portfolio allocation for somebody?
Yeah, it is kind of case by case. Like one question I'll ask during the discovery process if I'm meeting a prospect or a new client is you just kind of walk through scenarios, right?
Sure.
So let's say we're starting today, and then I talk to you in a month from now, and the portfolio is down. I'm going to go over a few numbers,
Sure.
and let me know when you would feel really uncomfortable.
Sure.
Okay, so the portfolio is down nothing. Of course, everyone's okay with that. The portfolio is down 5%. It's down 10%. It's
Sure.
down 20%. So at some point, you get a sense of when people get uncomfortable, and then you can think about, okay, what is a appropriate level of risk in the portfolio that would match that, right? If someone
Sure.
can't take being down 5%,
Sure.
then they need more fixed income, right?
Sure.
If someone's okay with having a 20% drop, they can have more
little
equity.
more
And that's kind of
equity.
more of just a personal
Yeah.
risk tolerance. You know, everyone's wired differently, and you can't always change that.
Yeah.
So you create a portfolio based on that. The other point you mentioned was time horizon for sure.
Yeah.
So if you have 30 plus years, you can go through a 2008, 2009, and then just not look at your portfolio until the next 2-3 years when it's back. You can go through a market crash like 2001 or the tech wreck. You can go through a bunch of these things, and then just if you look at the market kind of history over 30 years, rolling 30-year periods, it's always good, right? So just close your eyes and just keep on investing. In fact, buy when it's down, right?
Of course.
Try and do that. So time horizon for sure. The other would be like liquidity and income needs. This usually comes up for liquidity needs for sure for everyone, and then income needs for potentially older clients, right? You've made your money in your enterprise or in your professional life, and then now the income part of that is turned off, and the portfolio becomes the income, right? So you have to rely on the portfolio to pull out 5%, 6% a year, whatever it is for the plan to work. So that could change the risk level. The portfolio now has to generate sufficient income. You can't have it be swinging at 20% a year every year, because now you're drawing down something every year.
Sure.
That's one. And then for liquidity, I always tell people, if you have something on the immediate horizon, right? I'm going to buy a car next year or 2 years from now. That should not be in the market, right? That should not be 100% in stocks,
100%.
And you would know why. You know, again, it comes back to kind of psychology, recent history. People might assume, well, if I invested for a year, I should be fine, right? Well, no, there's definitely periods in history where the market's down for 1 year, 2 years, 3 years. There is a period with the S&P, the U.S. stock market, where if you invested in the year 2000 and you held it for 10 years, so the year 2010, you would end that decade actually down because you had two big drops. You had 2000 and you had 2008. So you could have, in historical context, a 10-year period where you lose money, right? Right. So that's why it totally makes sense for, hey, I got to pay for school in 3 years, 4 years. Those should not be 100% in stocks. Those should really be diversified, fixed income, and even cash sometimes if it's coming up in the very close future. So that's all comes down to the portfolio and asset allocation.
Yeah, absolutely. Because oftentimes we don't always think about it, but just even what happened with the recent tariff news, and all of a sudden, next day you wake up and the markets are down, and if somebody needed money on that particular day and they needed to cash it out, they would be in a significant loss at that point at the end of the day, right? So it's really important to make sure we are considering, hey, what is the time horizon when you're investing? What is your risk appetite at the end of the day? Like, you know, if you're not able to stomach the risk when you wake up one day or stomach a loss next day, maybe you shouldn't be in a very risky portfolio, and it's important to make sure you think about these things. And the last part to your point, the liquidity part of it, like if you need the funds in a short time horizon, make sure you're not invested, because you know you just don't know when the markets are going to act